It's Brian Preston, the money guy.
So let's get the bad news out of the way first. Whenever somebody says, give me the good news, bad news, I always start with the bad news.
Yeah.
So let's talk about who's actually going to get beat up by this tax policy. And you're going to notice a trend. High income. I'm just going to say high income, because high income single filers. This is everybody who's, makes a great income, not married, it's really somewhere around 180. It's over 150, 160 if you look at the tax codes, but somewhere between 180 to $400,000. If you're a single high income person, your tax rates, they didn't get better in this tax policy. Yeah. They definitely didn't improve. So you're going to notice there's going to be potentially a slight increase on your taxes, because what happened is when they set up the new tax rates, they trimmed a little bit off of all the different tax rates, but they didn't move the bar too far for high income single individuals. And I think, the way I look at tax policy, I think what happened, it wasn't like they got in a room and they said, who can we stick it to? I think what actually happens is that they're working with this $1.5 trillion deficit cap. That's why this thing all sunsets at 2025 anyway. And they knew they wanted to make the corporate tax cuts permanent. So they had to figure out, how do we keep this thing under $1.5 trillion? So they started playing with the numbers, and unfortunately, high income single filers kind of carried a lot of that. The next group is high income taxpayers that live in high salt areas. And I like it when all the journalists are saying salt constantly, but they never, what salt means is state and local taxes. So if you live in a community, a state or a local community that has high, state income taxes, high property taxes, high local community taxes, there could be some issues for you, because
so California,
Connecticut, New York, DC area, all those areas, and it's not necessarily because the tax rates went up in those areas. It's just that a big loophole that a lot of people in high income tax areas have been enjoying for years is getting closed down a little bit. And that's where you've seen a lot of discussion about this. So we're going to be talking about that. And I'm even going to talk about the macro impact. And I don't think anybody else out there is doing these type of discussions. So tune in for that part as we get deeper into this. Sure. But those are the two big losers in this thing. Yep. The winners, and here's the thing, is if you're not following us on Twitter, I would encourage you, go look at our Twitter feed. We don't drive you crazy. It's not like I'm telling you every time I'm dropping off the kids, at school, or, cause I've seen people, I follow bloggers and other things, and you're like, is that really worthwhile in sharing? So we don't load you up with that type of stuff. It's really, we try to hit you with things we think that you would be interested in. One of them, I put a tool that the New York Times had put out for. It was an interactive tool that you could look at on your phone, on your iPads, your tablets, or even your desktop computer, where you just told, just a few items about yourself, your income, were you married, single, head of household, how many children did you have, and what's your standard deduction versus itemized deductions. You put that data in, it would give you kind of a range of how much you could anticipate benefiting from the new tax policy. And according to their article, 75% of taxpayers will benefit from this new tax policy as of 2018.
That's surprising to me. That's a pretty substantial number. To have any sort of tax reform where 75% of folks improve their situation is a little unique.
So I would encourage you, go out there and check out, and I'll see if if Lisa can put the link on this, also in the show notes. So if you go to moneyguy.com, or you can, like I said, go on Twitter, and you'll see that link to that interactive calculator to see how these taxes impact you. But the other big winners is corporations. Corporations will see their tax rates go from 35% to pretty much what is a flat rate of 21%. The 35% jumps up pretty quickly. What most people don't realize, that 35% actually is a 38%, but it comes back down to 35 once the income of the company is over, $18 million and some change. But it's one of those things where corporations, and this portion of the tax policy reform will be permanent, is going from 35% to 21%. I think this is where there's been a lot of communication in the press about how this is going to benefit all these big corporations. But I want to talk about where does that money go and what does that impact? Because I think that's an important thing, is that I think that extra money, you've already seen, I think it was up to 17 to 18 different companies have announced they're doing $1,000 bonuses to their employees because of this. So I do think that hopefully it's kind of, we'll get a stimulus impact from these companies giving some more money to their employees. So there will be an increase in employees' wages and bonuses. And it's not even the employees that you see in the headlines. I know I was at my daughter's Christmas performance.
Right.
And, I was talking to the guy, one of the parents sitting next to me. I'm friends with his family. And I was saying, he asked me, he said, what's going on with this tax bill? It just got passed. I know the president signed it, but what are your thoughts? I said, well, it's going to be interesting to see how this plays out. He goes, well, our CEO just sent an email to expect bigger bonuses as a result of this. So I think that this, hopefully, you will see some employee wages and bonuses bump ups from that benefit, that money.
And was he excited about it?
Down.
Was the guy excited about it?
He was definitely excited.
So it's potentially even a morale boost, right?
Well, that's what we were talking about, before we started doing the show. I think when you take out the politics of it, if you think about efficiency of use of wallet space, who do you want to have the money? I think I'd rather you, my listeners, have the money in your back pocket than I necessarily would with the government. And I'm going to explain some of that in the macro when I get to that point of the show as well. The other thing is, I think you'll benefit from this spread is you're hoping that there's a lot of new capital investments. I know that's what a lot of the hope is when our elected officials came up with this tax policy, is that they want, companies to start bringing more manufacturing and other things. So hopefully there'll be some capital investments. And then here's what I'm hopeful for, us all being a financial planning podcast, as well as giving you some thoughts on investing and so forth. I'm hoping your 401k goes up. I'm hoping your 403b, because I'm hoping that we're going to see this surge of money come in from companies where it does get put to work in the economy, and we are the net beneficiaries through our 401ks and pensions and everything else. That's the hope. Yep. So we'll quickly see in the next year if this plays out. And that's what, without going too deep, I mean, there's also a part of this provision that I thought was kind of unique. And I give you guys way too much detail, but I just want you to know, a lot of people don't realize, like Apple, a lot of the big companies that are household names, they had started doing a lot of structuring their business overseas. Ireland became kind of a tax haven, and it's because their tax rate was like 12.5%. Right. You compare 35% to 12.5%, and these corporations were kind of putting themselves in a pretzel to take advantage of, all this lower tax rates. I think that the net loser is going to be these countries like Ireland and so forth that have been getting taking advantage of the companies moving assets over there. It will be nice if they could start bringing some of that back here to the United States. So there's a repatriation tax. It ranges between, wasn't it like 8% to 15.5%, depending upon whether it's cash or an illiquid. But that's still substantially lower than the old 35%. So hopefully there'll be more money that does come back in the United States and has a benefit.
Another cross section of the population that will probably benefit from this tax reform. And we see this a lot with the clients that we work with, are individuals and families who are subject to alternative minimum tax. While it's still there and it's still going to be present in the tax code, it's not going to capture as wide a swath of the population, I believe. I mean, it was, and I'm trying to find my numbers. I had it, but from memory, it was once you got over 150, 160, all the way up to 600,000, you started having alternative minimum tax. And for you guys that don't know, I always like to bring it back, because you read an article and go, gosh, I'm sure that was helpful, but he didn't tell me what he was talking about. Alternative minimum tax is essentially a flat tax. When I hear people come to me all the time and say, Brian, we ought to just have a flat tax, I'm like, we got one. It's called alternative minimum tax, because what this thing does in the past is it takes all your deductions, because the way taxes work currently is, you make your money and then you take out your deductions, so your itemized deductions. We'll talk about that in greater detail in a minute. But then you multiply that by your tax rate. But the problem is that if your deductions get too high, according to the government, they have a flat tax of 26 to 28%, where they take out your deductions, compare it to their 26 to 28% rate. And if that tax is higher than your tax, they say, nope, you're going to do this flat tax. You get to pay the higher of the two.
You get to pay the higher of the two. So And this was originally set up to catch the richest of the rich.
Right.
But as, because of inflation and other things, it started catching a lot of what they perceive as middle class families. So it's nice that alternative minimum tax is going to improve significantly. Mm-hmm. It's not done away with. That was originally a legislative goal, I think, but it's still there. But the teeth have been reduced greatly, and we'll get into that in the detail section as well. The other one, this one, I tell you, if you're thinking about estate taxes, it cracks me up when I hear people, and it's like people haven't updated their textbooks. People who are still selling trust and life insurance and other things because of this big boogeyman of estate taxes.
Right.
I mean, and just to give people a quick history lesson, when I first started doing this for a living, I think the estate exemption was super low. It was like $675,000.
And so if you had a 401k from your whole working career, a house that was
Equity,
paid for.
House paid for. I mean, in the past it was structured where if you had an estate over $675,000, you could see half to 50 to 55% of your assets be, or you'd see taxes of 50,
Sure.
tax rates of 50% to 55% of those assets over 675. You can see how that's a scary thing because it's not hard to get caught in that net. We've seen that number getting pushed higher and higher, where currently the number is 5.49 million per person, which already was a pretty generous, because especially if you add that to a spouse, you can see you're getting really close to $11 million of net worth before you had to worry about estate tax. Well, under this tax policy, up until the year 2025, now it's $11 million per person.
Or $22 million for families.
So that's, estate taxes is getting to be one of those boogeymen that you worry about, but you find out when you look under the bed, there's really nothing to be scared of.
It only applies to the ultra high net worth.
Yeah, because I mean, now we're talking about even small business, because that's how when it was 675,000, there was a lot of people that were panicked because this was capturing a lot of small businesses and making them do fire sales. I think a lot of that has now been taken care of. So that's a win, for people who have bigger estate issues.